time to maximize profitability and cash flow. It's time to learn habits and hacks from the best e-com CEOs. It's time for Return on Podcast with me, Tyler Jefcoat. All right, welcome back, guys. Tyler with Seller Accountant, and we are in the second installment of a mini-series on how e-commerce entrepreneurs can read their financial statements better. I want to empower you guys. It doesn't need to be mysterious. It doesn't need to be something that's challenging. It needs to be easy for you to take your data and make good choices based on it. And so the first video, if you missed it, go back and watch it, was just about revenue. What goes in the revenue side? How do you interpret the revenue side of your profit and loss statement? In today's video, I want to talk about the cost of goods sold section of your P&L. Let's dive in. All right, so in front of us, we have one of the profit and loss statements we looked at in the last video, but now we're scrolling down a little bit where this is that same situation that has a Shopify and wholesale exposure. And now we're looking at the cost of goods sold. So a quick reminder and clarification. There is a cost of goods sold section of your profit and loss statement. That's the section that's in green on your screen. It's kind of everything. And then there is a cost of goods sold category or account, which is basically how much did the product cost to buy. And so that's circled in red. And so let me just tell you, here's what needs to be in your cost of goods sold. This is the most controversial video that I'm going to do because not all US accountants like to do this the way I like to do this. But let me sell you on my idea here, and then you do it however you want to do it. I believe, and I believe this firmly, that the data we have access to in the e-commerce world makes it crucial, imperative that we can measure as many direct expenses above the line as possible so that we can know what our true gross profit margin is and not some fake gross profit margin. What I really don't like as a CFO is I really don't like having things like logistics charges or even some storage charges, and the one that gets me occasionally a little bit of flack from CPAs is advertising. I don't like those being hidden down here in our SG&A kind of overhead area, because when those are hidden down there, we ignore them. And so at Seller Accountant, we always, unless there's an exception, put as many directly attributable expenses as possible up here above the line, because it allows us to get a true picture of what the real gross profit is. Everything else down here in the bottom half is overhead. I got to keep it minimal. I got to manage it. But everything that's driving direct sales is up here on the top. And so obviously, first and foremost is your actual cost of goods sold. What did it cost me to land the product? I mentioned this in the first video. I just want to say it again. I'm assuming that you or your team are doing some form of accrual accounting where this is real cost of goods sold. It's not done on a cash basis. You can't afford to do that in e-commerce. You've got to have real accounting. But after you get your products booked, I want to also encourage you to add some of your inbound logistics, maybe a freight forwarding charge, some of those outbound logistics, any marketplace selling fees or payment processor fees, and then your advertising. And you're going to be left with not kind of sort of gross profit, but a true, what's called contribution margin. At Seller Accountant, we call this PAG, which is kind of true gross profit, post-advertising gross profit. And that's the truest picture of how effective the engine of your business is at generating profit. Let me show you another example here. So once you start understanding the elements that need to be in your P&L section called cost of goods sold, now we got to get good at kind of diagnosing. I mean, with sales last week, I'm like, hey, you want more sales, launch more products, right? It's kind of straightforward. But when it comes to cost of goods sold, what we're really asking is, am I happy with my margins? And if I'm not happy with my margins, what do I do about that? And for me, this really goes to, you've got to diagnose what the real problem is so that you can solve it. And so on the example that you can see here on the screen, this is a brand that has premium margins. I mean, look at this cost of goods sold. It's less than 13%. There are sellers out there watching this video that are drooling over this level of margin. This is incredible. Here's the challenge. The amount of advertising juice needed to drive sales to these channels is extremely high. And as a result, our bottom line gross profit margin is really low. It's unacceptably low. It's something that we're working really hard to improve with this client. And so the problem is obviously not cost of goods sold on this particular business. It really isn't logistics. It's definitely advertising. And so I'll tell you exactly what we did with this client as we looked very, very closely at those advertising expenses and decided, wow, we need to get more focused on our Amazon ads. Wow, we needed to make sure we're holding some of our partners accountable for the performance of the channels that they're leading, right? The kinds of marketing efforts that they're leading. And I have great news. In the months since I created and kind of modified this P&L, the margins are getting much, much better. So that's really exciting news, but you don't know what to fix until you know exactly what the problem is. And so I think that's what I want to leave you with. When I look at a P&L and I'm trying to understand how happy or unhappy I am with margins, the most common culprits of sadness, it could be if I have a really high refund rate, right? So let's see, like if my refund rates are out of whack, which for the one we're looking at here, not out of whack. If my coupons or promotional discounts are out of whack, well, this is pretty high, but not that high. Then I'm going to look at my landed cost of goods sold. Again, these guys are premium in that area. And then I'm going to take a deeper dive at the individual advertising expenses, which again, of course, is the culprit for this particular seller. And so as a CEO, what you need to do, you get this monthly financial each month. And remember, like I told you in the first video, you might compare it month over month and year over year, because I want to have some context to understand. I mean, is 12% cost of goods sold normal, or is that unusual? Looks like it's pretty normal. Okay. Is a full 56% advertising budget normal? Well, it's actually getting better, but it's not normal what we know about the industry. It's not a good number, right? And so again, this is important. You got to understand what belongs in your cost of goods sold section, which is a lot of things. And you got to understand how to diagnose the things that might be broken. Occasionally you might find an accounting error. Hey, wait a minute. Looks like we need to put an inventory adjustment in there or something like that. Most of the time you're going to smoke out performance challenges with your brand so that you can take the right actions to make more money. Come back next week. We're going to talk about how to handle SG&A and other expenses, and then we'll pivot to the balance sheet, which I think will be interesting for you guys that have never learned how to study a balance sheet. Until then, take care.